Good morning and a very warm welcome to the second day of our annual research conference. My name is Hoerova and I am from the ECB's research department. I will guide you through this session. The session is about central banks and regulation. We will have 2 papers, 2 discussants per paper, and a Q&A after each paper. With the first paper, we will return to an important topic of financial stability and monetary policy that we already discussed yesterday. The presenter is Professor Tobias Berg from Goethe University, Frankfurt. Welcome. And the discussants are Professor Amir Sufi from the University of Chicago Booth School of Business and Professor José-Luis Peydró from Lewis University and EIEF. Welcome. Without further ado, it is my pleasure to give the floor to Tobias. He will talk about unintended consequences of QE, real estate prices and financial stability. Tobias, the floor is yours. You have 20 minutes.
So thank you, first of all, for including our paper on the program. It's joint work with Rainer Haselmann, Thomas Kick, and Sebastian Schreiber. One of the authors is at Bundesbank, so the typical disclaimer applies. Our paper is about one QE program, the Corporate Sector Purchase Program. And let me give you, it's early in the morning, so let me give you the key messages right away. So in the following 20 minutes, I'll try to convince you that this CSPP program increased real estate prices in Germany and impaired financial stability in Germany. For those of you who are not interested in QE, which is maybe unlikely at this event, or let's put it like this, who are interested beyond QE, there's also a message about real estate prices in general. We find elasticities of real estate prices to credit supply shocks, to positive credit supply shocks, that are significantly higher than prior estimates, okay? And I'll walk through the presentation and hopefully be able to explain to you why. So as I said, our paper is about the Corporate Sector Purchase Program. So the Corporate Sector Purchase Program, or in short CSPP, was enacted by the ECB in 2016. The ECB bought at the peak 350 billion corporate bonds, investment grade rated. So this is a sizable amount. So this was 31% of the outstanding amount of eligible bonds and equivalent to 7% of Eurozone bank lending. So really a big program relative kind of to corporate lending or the corporate bond market. There's similar programs in other countries, Japan, UK, and the US. And the key rationale here cited by the ECB was to overcome credit supply frictions that were present in some European countries. Let me give you an overview about these credit supply frictions. So what you see on this graph is the answer to the question to firms asked to firms, do you have problems with access to finance? And the blue line here is Germany. And what you can see is that Germany at that time when the CSPP was enacted did not have a problem with access to finance. So this is what we label in the paper as a credit saturated market. So in that sense, we are asking a kind of strange question. We are asking the question, what happens if you implement a program in a country where the frictions that it's supposed to address do not exist? So it's a little bit akin to asking, what happens if you send a firefighter to a house that's not burning? We still think this question is relevant because most monetary unions are actually quite heterogeneous. So certain conditions might apply to some areas but not to others. Plus, even if you have a homogeneous union, it could be that certain programs are maybe enacted too long when the underlying frictions are already resolved. So the prior literature on QE and in particular CSPP has established a very simple channel. The ECB or the Federal Reserve or any central bank, when they buy corporate bonds, then those large investment grade rated firms that can issue bonds shift from bank lending to issuing more corporate bonds. And this frees up lending capacity at these affected banks. And so these affected banks increase lending to smaller and medium-sized enterprises. So the message in prior papers was pretty positive that not only the large firms benefit, but also the smaller and medium-sized enterprises actually benefit from an increase in credit supply. We add to this literature actually in 2 ways. The first one is we look at a credit saturated market. At Germany, where these credit supply frictions at that time did not exist to that extent. And number two, we look at actually where is this additional lending going? And as you can see probably from my initial remarks, the answer will be it fully goes into real estate lending with the consequences that I would document in the following. Our data is pretty standard data. So we use credit registry data from Germany from 2012 to 2019, so symmetric around this CSPP start in 2016. We enrich it with firm level data and bank level data. And for the county level analysis we use classical or standard home price indices from Bulwiengesa plus county level characteristics. Again, nothing special about this from standard databases. Empirically, what we do is a simple difference in difference. So we compare the lending of affected banks to those by unaffected banks pre and post CSPP. If I talk about affected banks, I'll obviously have to tell you what are affected banks. So affected banks, in our case, are those where the share of lending to these CSPP eligible firms is above the median. So if a simple 50-50 split, did this bank actually had a pretty high exposure to these investment grade rated large corporations in its lending portfolio or a smaller one? Okay? And this carries over to the county level where we aggregate the CSPP effectiveness based on the firms that sit in this particular county. So all in all, a quite standard, simple difference in difference. And the typical question you would always ask for a difference in difference is obviously, are treated and controlled banks comparable? And the first answer is, they're obviously not comparable on those things where we don't want them to be comparable, where by design they are different. So if you look here at the share of eligible firms, this is on average a little bit more than 13% for treated banks and close to zero for control banks. So these are numbers which can be important to keep in mind. So those treated banks have roughly 13.5% of their loan portfolio, which has gone prior to CSPP to CSPP eligible firms. Now, obviously, these CSPP eligible firms are investment grade rated. So anything that has to do with the creditworthiness of the bank portfolio, the share of high yield exposure, the average PD is therefore also lower for treated banks than for control banks. But on all other characteristics, which are unrelated to this credit quality criterion, these banks are rather similar. No matter whether you look at profit and loss statements or bank balance sheet information, they are rather similar on all other respects. A small exception is the total assets, because all the big banks in Germany, they're actually exposed to the CSPP. So while median assets are slightly smaller for treated banks, average assets are somewhat bigger, while we can simply exclude the biggest 5 banks and you will see a very similar size distribution here. In Germany, most banks are locally active. This obviously also helps later on for identification of the county level results. So let me show you the key result in 4 or 5 pictures here. First of all, as expected and as already documented by prior paper, these are all difference, the standard difference in difference coefficients. The share of CSP eligible portfolios in these treated banks' lending portfolios goes down. Why? Because these firms find it more attractive to issue bonds, given that bond spreads decreased. So this is kind of more or less a trivial result. You wouldn't find it that there'd be an issue with this. Economically, this adds up to, or cumulatively up to 2.5% at the end of our sample period, relative to the pre-CSPP exposure of a little bit more than 13%. Overall lending remains flat. So we don't find a difference in the size of the overall lending portfolio of treated and control banks. This begs for the question, where does the additional lending go to? CSPP lending goes down, so it must go up somewhere. That's simple balance sheet arithmetics. And it turns out it all ends up in real estate lending. So the blue line here, this is the dynamic version of, or basically the last two slides ago that I've shown you. The share of eligibles in the treated banks portfolio goes down. The share of real estate lending in the treated portfolio goes up. And all other lending remains flat. Pre-CSPP for treated banks, real estate lending was responsible for roughly 40%, so it's sizable, and the other portfolio for roughly 50%, with the CSPP part responsible for the rest. Now, real estate is not a homogeneous lending exposure. And so it's also important to look at where does it actually go to within the real estate portfolio. Remember, this is all corporate lending, so we're not talking about retail mortgages here, but we're talking about corporate lending. Now, if you look at it, we look at three different subsectors of the real estate industry. Construction, so these are the firms that actually build houses. Development, so these are the developers. And real estate asset managers, so these are the firms, like in the US, you would maybe call them REITs or so, that actually borrow money, buy houses to lend them out. In Germany, I have to say these real estate asset managers are pretty small, so with average assets around 10 million, so they're almost all bank dependent. Now, crucially, the construction sector and the development sector don't see any increase in credit. It's all concentrated in real estate asset managers. Why is this important? It's important because construction and development actually increases the supply of houses. They build and develop houses. Versus the asset manager, they actually increase the demand for houses by providing cheap lending to these firms who buy houses. So therefore, whenever you're interested in real estate prices, elasticity of real estate prices to credit supply, it's really important to ask the question, does this extra real estate lending actually end up in those subsectors that build houses and develop houses, or those that are on the buying side that actually buy houses? And here it all ends up in the real estate asset management industry, so kind of in the buy side, so to say, of this real estate market. Now you can look at this in more detail across all industries, because so far I've just lumped together all industries apart from real estate in one single bullet point or one single graph. And here you see it across 14 different industries. The coefficient for eligible is negative, the one for real estate asset managers is positive, and for all other industries we basically find a zero effect. Now, let me go to real estate prices. For real estate prices, we go on the county level. Okay? So we look at those counties that are more exposed to CSPP versus those that are less exposed to CSPP. And you see an increase of roughly 5% of real estate prices in this difference in different setting and interpretation in the treated counties. You also find an increase in typical measures of real estate valuation, price to rent ratios, or price to income ratios. I have to say, if you look at the descriptive statistics here, the treated counties tend to be more the counties with a slightly higher GDP per capita, so a little bit more the richer counties with slightly higher valuations. So it's not a catching up of poor counties or something like this in the real estate prices. And due to some quirks in the institution setting in Germany, you also find a slight increase in rents actually in these counties. So the income in these counties does not change at all compared to the control counties. Now, we have lots of robustness tests, and I just want to highlight a couple of these. So whenever you want to find an alternative explanation, you need an explanation that is consistent kind of with the following robustness tests. These effects start to kick in directly when the CSPP kicks in, so there are no pre-trends. Yeah? That's kind of number one that I want to highlight here. Number two that I want to highlight here, we don't find any effect for single-family houses. In Germany, single-family houses are almost never rented out. Okay? So you buy them when you live in them, but it's not a typical rental market. The proportion that is rented out is very, very small. So this is not a target for asset managers. These asset managers who want to buy real estate and rent them out, they buy apartments, apartment blocks, but not single-family houses. Okay? So this suggests that in the same counties, it's not the single-family houses or everything that's being lifted up, but just those areas or those properties where real estate asset managers actually invest. And the third one that I want to highlight here is we look at differences in treated and control counties, and we look at firms that are not in the real estate sector. Yeah? Think about manufacturing, services, and others. And we don't find any differential effect for growth or revenue or profitability. So we would argue that kind of these robustness tests put a rather high bar on any alternative explanation. There's one assumption that I'm clearly not going to defend, the stable unit treatment value assumption or the no spillover assumption. It's clear that surely there will exist some spillovers across county because even the regional German banks are sometimes active a little bit across counties. So if at all, you could see our estimate as more a lower bound of the real effects here. Now you could ask, why real estate asset managers? What's the mechanism behind this? So one is a supply side argument. They seem to be a good substitution for the investment grade lending that went to the bond market. Why? Because there's a very high collateralization, real estate is treated favorable in the Basel regulation, so they attract a rather low risk weight. The other one is a demand side argument. One guy from a bank once told me when they needed to lend more and they didn't have lending opportunity, his boss told him, go to the real estate firms, they always need money. And this claim of go to the real estate firms, they always need money, in our economic terms would be, they have the highest elasticity. If you kind of slightly decrease rates or conditions, they will borrow much more, versus a manufacturing firm will not be thrilled if you offer them a 10 basis points discount. They will not just open up a new production line. And let me highlight this actually by showing you here two sectors, real estate asset management and manufacturing. These are both small firms on average in Germany, so highly reliant on banks. But you see a big difference in their employment to total asset ratio, which means real estate asset managers stand out in that they are very capital intensive. You can manage a 10 million or 100 million real estate portfolio with very few people. You can't do that in manufacturing. So if you want to scale up in manufacturing or in the restaurant business, you also need to hire, but the labor market was pretty tight at that time in Germany. In real estate asset management, if capital becomes cheaper, you can easily actually scale up that business. Okay? And therefore, so I think this is one of the key arguments why we are saying this is actually where the money is flowing to. Okay, let me talk about, in my last one or two slides, about elasticities of real estate prices to credit supply and a little bit about financial stability. So we find an elasticity of real estate prices to credit supply of 0.8, which is 2 to 5 times higher than prior estimates in other papers that have used deregulation shocks or other shocks to credit supply. Why? We argue this is particularly the case because we are in this credit-saturated economy where basically construction firms, developers, they don't even find enough people to scale up. So if all the lending actually flows to real estate asset management, the buy side in the real estate sector, and not the ones who actually construct new houses, then you will see elasticities that are much higher than you get in, let's say, a typical credit supply expansion, which is more equally distributed across these sectors. So this matters because it means if you are in a hot economy, and if the additional lending supply is entirely going to these asset managers, you can see an increase in real estate prices much quicker than you might otherwise think from prior estimates in the literature. Why should we care? At the same time where this CSPP was increasing real estate prices in Germany, there were warnings by the European Systemic Risk Board about vulnerabilities in the real estate sector in Germany. So while kind of one part of the regulation was saying, oh, the buildup of real estate prices is maybe too fast or too big relative to fundamentals, other parts were driving this, the CSPP program in our case. And we're not necessarily taking a stance on whether this is a bubble or not, because this is very hard to judge with hard data in real time. But at least these warnings by the Systemic Risk Board and others suggest that policymakers were concerned about the buildup of real estate prices in Germany. And the targeted long-term refinancing operation by the ECB, that actually particularly excluded lending to real estate sector for particular that reason. Okay, I'll skip actually the European evidence. If you're more interested in evidence across other countries, feel free to ask during the discussion. So in the interest of time, I'll quickly talk about financial stability. When you look now at banks' changes to their average probability of default, but also loan loss provisions, they increase for treated firms. And that's not surprising, I think, because the low-risk firms or the low-risk exposures, they move to the bond market, And so the real estate exposure here is, in some sense, more risky than the exposure that went to the bond market. At the same time, banks become more reliant on real estate collateral. They already had a large reliance, and real estate asset manager again bring real estate collateral, and these portfolios become somewhat more concentrated. You also see higher write-offs for treated firms. You don't see any change in net interest income. So these banks are not able to charge higher interest rates. Yeah, they are short in lending, so they need to lend more, but at lower rates on average to riskier firms, so that equalizes net interest income again, so that their return on assets decreases by 6 to 7%. So this is the evidence why we point out it might have been negative for financial stability in Germany. So to wrap up again with the key messages, we argue the CSPP increased real estate prices in Germany because the additional lending entirely went to the real estate sector, to the demand side. It impaired financial stability, and beyond CSPP, when you have a credit boom that entirely goes to the demand side, to the asset managers, you see pretty high elasticities of prices to credit supply. Thank you.
The first discussant is Amir Sufi. Amir, the floor is yours.
All right, first, thank you very much to the European Central Bank and to Hoover for inviting me to discuss this really interesting paper. And in general, thank you for running such a fantastic conference. Everything has been really great. Let me give you my bottom line. This is a really great paper. I think it's great for a lot of reasons. First of all, we always want to know from a policy perspective what the ultimate effects were. And I think this is just a great postmortem on the corporate sector purchase program. Furthermore, I really like the paper because it's at the intersection of finance and the real economy. And I think we always need to be careful, as a financial economist myself, that we don't get too far removed from the real economy. So this paper has a really nice way of showing you not only the financial side, meaning how lending switched across different firms, but then also tracing it to the real side of the economy, because I think we would all agree that's ultimately what we care about: jobs, buildings, homes. And that's what this paper does, is really to trace through what the implications are for the real economy. So kudos to the author, and I think this is a great example of how research using the fantastic data at central banks should be done. I think Tobias did such a great job summarizing the paper. I'm going to do this really quick. So the focus is on bank lending in Germany. It's a diff and diff kind of standard argument where you're going to sort banks in Germany based on the fraction of the lending that was going to CSPP eligible borrowers, with the idea that, which was very prominently discussed by the ECB, that if the borrowers are eligible for the program, then those borrowers will then leave or not need the money from the bank, so that would free up lending at the bank to go to other firms, hopefully more small and medium enterprises, the kinds of firms that couldn't get credit easily. That was one of the primary justifications for the CSPP. So you sort the banks like that. You saw exactly, Tobias shows you these very nice results about where the lending goes. They go primarily to real estate for the treatment banks. Then you're going to kind of switch to a geographic level analysis where you're going to sort counties based on whether they're exposed to these treatment banks, and the treatment banks, the counties exposed to the treatment banks then have a much larger rise in real estate. So the kind of bottom line is in credit-saturated economies, efforts to boost bank lending to SMEs are unproductive and even adverse for financial stability. The first set of comments I want to give are kind of the standard, like almost referee, what we, I don't know if this phrase translates across. We say kicking the tires, in America when we're buying a car, just to make sure that, the car is kind of working. So let me give you kind of more discussant referee type comments, and then I want to move a little bit more big picture. I think the first thing is there's no doubt that this paper is novel, so I'm not questioning the novelty of the findings, but I think there is a lot of research on the CSPP, and I thought it would be helpful if the authors can do a little bit more in making sure that they distinguish exactly how their findings are related to the existing literature, especially this Gross-Roschkamp article, which has this flavor of, well, well, the money, a very similar design, and it doesn't talk about real estate at all, but it says, well, the money went to profitable small and medium enterprises. So I think maybe these real estate managers are quite profitable. Maybe that's how we reconcile, but I thought I would just like to know a little bit more about exactly how this paper is related to that paper, which has a little bit more of a positive spin on what the ultimate outcomes were from the program. If I were to isolate one main empirical concern is that, and I'm going to talk about this in more detail on the next slide, so let me just quickly say it, that you might worry that some of the treatment effect that they're finding is some sense of mean reversion, because once you sort banks on how much lending is going to eligible borrowers, you are in some sense sorting in the opposite of how much real estate lending they're doing. And so you worry that you're sorting on exactly the outcome variable. There might be a mechanical mean reversion, which I think the authors could easily resolve that concern with a few different strategies. The third main comment is just going to be, this is a bit of a cheap shot. I mean, the real estate findings are so stunning that they could probably make their own paper. And as a result, there's a lot of arguments that Tobias even said in his presentation, which I feel could be backed up with analysis. So why are these estimates on the elasticity of real estate prices with respect to credit supply so large? That's a question. I've thought about that elasticity a lot in my own research, and I think there are good arguments. For example, maybe housing supply is more inelastic in these areas. Maybe there is this credit saturated. There's a lot of arguments in the paper, but again, there could be more analysis to backing those arguments. And again, it's a bit of a cheap shot because that finding almost is another paper. It's so stunning how large those elasticities are. So, either lengthen the paper, maybe separate it off, or maybe write a follow-on paper. Here's the mean reversion point I wanted to show you. So let me just quickly say what I said before, right? So when you sort when you sort the banks by the fraction of lending going to eligible firms, you are in some sense sorting on 1 minus the amount of lending going to real estate non-eligible firms. So anytime you're sorting on the variable you're ultimately going to be looking at the outcome, you do worry about mechanical mean reversion. And there's a little bit of evidence that maybe some of that's there. If you just look in the pre-period, it does look like real estate lending is kind of going down a little bit for the treatment group. And so, there are ways you can easily kind of correct for this. There's so many robustness tests in the paper that I don't think this is going to matter ultimately, but I think in terms of a nitpicky referee comment, I think this is something I would push the authors on. And then let me step back and take a big picture sense of what I kind of think about the paper, given my own research, given the research of others. And that is, I think we need to appreciate more and more that in advanced economies, banks find it very useful in equilibrium to be lending to real estate firms. This is this fantastic paper by Dai Mueller and Emil Werner, who talked yesterday. I feel good. Emil didn't talk about any of his own research yesterday, so I get to talk about some of his research. And they have this fantastic point. They're sorting on real GDP per capita. So this is a paper about structural transformation, right? And it's showing you how much of value added is in real estate in richer countries, how much of employment, and then this really stunning finding, which is how much of credit is then allocated to real estate as countries get richer and richer, okay? Very important point, that when you're thinking about banks, and I think, again, even intermediation scholars aren't appreciating this as much as they need to. When you think about banks, you should be thinking about real estate. Like, banks primarily are focused on real estate, at least a plurality of what they're doing. In contrast, if you look at services, that's where the value-added employment kind of shift in really rich countries. Whereas banks and credit in general is pretty flat. Okay, so banks are always kind of suffering this issue in advanced economies, which is the most exciting, growing parts of the economy are the parts of the economy they don't focus in much. And I want to be very clear, when people say services, they sometimes think about what I would say kind of very boring, unproductive, like retail and restaurants. That's not at all what services are in advanced economy. Services are professional, scientific, technical services, business services. They're information services like Oracle and Google and Apple. So these are the industries that really skyrocket in importance in advanced economies. So why does that matter? Let me just go through a few numbers to show you. So if policy can only rely on banks, what should we expect? So the first thing I'm showing you here, now I'm an expert in the US, so I'm showing you a mix of US and German data here. This is the US. The change in value added by two-digit NAICS represents the change in value added from the 1970s to the last 10 years in the United States. And these are the top 5 industries that have shifted. So everyone always knows manufacturing's gone down. I always find that a little unsatisfying. Well, what's going up, right? Shares have to add up to 100. So you can see business services is number 1, then healthcare, then real estate, then administrative and support, and then information, right? 5 arguably of the most important industries now in advanced economies. So these are the industries that have been growing over time a lot. The authors were nice enough to share with me the portfolio shares of lending by German banks across all the NAICS. And you can see that German banks are doing very, very little business in 4 of the 5 fastest growing industries in advanced economies. 30% is in real estate. And if you add up the rest, maybe you get some share. But again, these are portfolio shares. So you can see that very little of the lending is going to the firms in the industries that are growing fastest. Now, this is based on my own research. We exclude real estate, so I want to make comparison fair. So in the next column, I've just excluded real estate. So that's just a easy transformation. And now I'm showing you from some of the research I've been working on. It's not publicly available yet, but hopefully will be in the next. The portfolio shares of private equity, venture capital, and direct lending, private credit. And what you see right away is, maybe not surprisingly, that the portfolio shares of these other intermediaries are much larger in these fastest growing parts of the economy. And so the bottom line for me is if you have a bank-centric economy and you only have policy levers over banks, it seems likely that the money is going to flow into real estate. So, I think, is this phrase credit saturated really fair for Germany? Well, maybe we mean bank credit saturated. But venture capital and private equity are intermediaries. They're not intermediaries that do debt financing, but they are intermediaries. And so I think there's like an agenda in the background, like monetary policy or central banking in an intangible economy. Like, how can central banks actually affect these other industries? And I think that's going to be a big question as we think about the implications of these findings. So overall, this is a great paper, a must read, and hopefully the foundation for more research. At a high level, my main takeaway is banks are not well positioned to finance the new economy. The policies designed to boost bank lending will likely affect real estate, consistent with the study's results. And we need more research on how central banking interacts with the intangible economy. Thank you very much.
José-Luis Peydró from Lewis University and EIEF. Jose, all yours.
Yeah. So thanks a lot for inviting me to discuss this very nice paper, and also to be here in this conference. I learned a lot yesterday and this morning. So basically, very briefly in one-page summary, basically the question is, what are the effects of expansive monetary policy and one particular monetary policy, which is QE on buying corporate debt, in a country in which is not supposed to be having expansive monetary policy because there are no credit crunch type of problems as in the south of Europe. The data is, say, Germany, because Germany is not suffering these credit supply problems, with administrative data and with the introduction on this particular policy, the CSPP. The results are that the money goes not to the real sector in a sense, not to the real economy, and in particular go to the real sector, and within the real sector doesn't go to constructors and developers, but to real estate managers. And there is an associated, and this implies financial stability, some loan defaults, and there is an elasticity between real estate prices and credit supply, which tends to be high in the literature, around 0.84. So this is truly a very important paper. First of all, it's extremely polished. So it's a very polished paper. The question is super important, both for academia and for policy. The identification is excellent, and the results are very interesting. I'm going to pick up on some comments related to policy. So the authors conclude that there are adverse effects from these policies, in particular financial stability. So my discussion is going to touch on, is complementary to Amir, and is going to touch on public policy. Before I tell you about the public policy, let me just do only one slide on type of referee type of discussion. So the elasticity is very high, 0.84. And the authors put this hypothesis of saturated credit markets. In a sense, you don't need more liquidity and more credit in Germany because Germany is doing great. So going back to the presentation of Raghu yesterday, is kind of the arrest start. Maybe you're using this policy in Portugal and Spain and Italy because given the economic fundamentals, interest rates are high, and therefore you need expansive monetary policy, but that is not the case, say, in Germany. Okay, and so this is the hypothesis. And just very referee type of comment, and the only one that I have here, the others are more big picture, is that at the same time that the ECB introduced this policy, they introduced two massive policies, which is the normal quantitative easing, which is you buy government debts, and also they bought massively government debts from Germany, and you have this NIRP, negative interest rate policy, which started in mid-2014, but then in 2016 they lowered again, and it's the first time that truly negative rates were in the economy. Okay, so you have these two policies, and the elasticity is very high. So a key point is to say, and this is a diff in diff, so is a correlation between the banks and the areas that are more benefited from the CSPP are also more benefited by NIRP and QE or no? If they are not, which should be in the balance table, so I would advise you to put those things in the balance table, that's fine. If they are correlated, then you should fully control for those ones because part of the 0.84 might be picking up all these alternative policies. This is purely monetary policy, but at the same time in Germany there was more than 1 million refugees, which implies things on real estate, on economy. Are all these guys, again, uncorrelated with your cross-sectional variation or no? This is my only comment on kind of referee. The rest are a kind of more policy. Before I enter into the policy, and I have only 5 minutes, let me just say very briefly, I'm going to say very briefly, so this expansive monetary policy is a contractual shock to banks, because banks receive less credit demand from the big companies. Now, in a Modigliani-Miller type of world, Modigliani-Miller type of world, like in a sense, there is like the saturated credit market. You don't need to invest this money because all the firms are fine. Okay? Let's then, if they are fine, and this is the hypothesis, then either the banks are taking too much risk. Why? Because you have expansive monetary policy, but it's contractive to the banks. The charter value of the banks goes down, and then they take more risk. So basically, the private NPV of the loan is negative. But it could be that it's positive. This is one hypothesis. It could be that it's positive, the private NPV, but what is negative is the social NPV. Why? Because there are these externalities on financial stability that you don't internalize. So it will be very important to understand these frictions. But I want to understand these frictions is for policy, because as I was saying, my comments are on policy. So the first line of defense is the prudential policy. And the prudential policy, again, is very important, the friction. Is the friction credit supply as you put forward, or is the friction more credit demand? Because then you can do macroprudential policy, and this is very important in the euro area, which the macroprudential policy, part of the macroprudential policy is at the state level, it's not at the ECB level. But then, of course, you need to say, should I use macropru, and then on borrowers, credit demand, or on lenders, credit supply. You could also use countercyclical capital buffer. Let me advertise some of my papers. Raghu was very nice advertising some of my papers yesterday. But I have this old paper with Angela Maddaloni that we find that softer monetary policy, soften lending standards, but this is reduced with tightening of prudential policy. So the question could be, you could read this, maybe the ECB did too much, or you could say maybe the German authorities, the German Bundesbank, the government, they should have introduced countercyclical capital buffers. They did not. Okay, so you have this monetary policy, which might be potentially not optimal, but you have other policy tools to combat this. Now, these buffers, truly speaking, if they would have had those buffers, they are tiny. They are truly tiny. And there was a comment yesterday, an answer by Ragu on contracyclical capitals in Spain, which I studied. We have a paper in the Journal of Political Economy on that. So those buffers were working amazingly well. But they were 1% of total assets. They were 25% of equity, so they are huge. The bankers in Spain complain because they are 25% of equity, but they are 1% of total assets. And our crisis was not 1% of total assets, was much larger. So in a sense, one of the big problems of prudential policy is that the buffers might be too small depending on the imbalances. So if the imbalances are high, maybe it's not enough, maybe it's good prudential policy, but maybe it's not enough. So going back to the presentation of Raul yesterday, maybe monetary policy is interesting. I presented this paper here 2 weeks before at the Silicon Valley Bank, this paper on monetary policy EU. I just wanted to make one point on the link between monetary policy rates and instability. So it's just not purely low rates. You can have low rates, but these low rates should be lower than a particular threshold, systematic component of monetary policy, R star, whatever. So it should be low for long, but they should generate somehow a credit boom and asset price boom. Real estate is bad in the history. Okay, so you should have that. Then what you find in the history of financial crisis is that credit supply, which is consistent with your results, credit supply determinants of these booms, one part has to be coming from the credit supply. And then you have a strong tightening of monetary policy. But even if you have all these conditions, and there are many conditions, you can up to increase the probability of default, probability of a crisis up to 40%, which is high, but it's still, Germany didn't have a banking crisis. Regulation, many people in Europe think that regulation was good compared to the United States. We have the LCR, net stable funding ratio, some countercyclical capital buffers. But still, nevertheless, the probability of a crisis is high, but it's not so high. Still, the probability for not a crisis is even higher. So maybe this is outside this type of conference. Maybe the social costs, which are very important on financial stability, are other type of cost. So you are showing very clearly that there is an increase in real estate prices. You have a wonderful identification, which is some areas and some banks are more affected by this. They lend to these real estate agencies. They increase real estate prices massively. So I would love you to see whether this led to some political polarization, some political extremism. I think this social cost could be important, maybe zero. That would be wonderful for this audience. That would be wonderful, no? But maybe there is some potential effects. And you have the perfect setting, identification setting, to do this. My last slide is just to say that, let me tell you another thing from Spain. You might not know that. In Spain, so first of all, in Spain, we also had, similar to you, we had interest rates which were very low at that time. In 2003, 2002, Ireland and Spain had extremely low interest rates. Because the sick man of Europe at that time, I think the economist said, was Germany. So the interest rates were very low. And this created a massive expansion of credit. But at the same time, there was a relaxation on real estate construction. So you would have asset prices going up and construction going up. Here, everything in the German case is just real estate prices, because the loans don't go to the construction and developers. Now, another thing, maybe another paper that you could write is, since Germany is a federal state, since the regulation is different across landers and across cities, you could exploit whether in landers and in cities in which it's easier to build, then the expansion of credit was also going to construction companies and developers. Then you find not only higher real estate prices, but higher construction real estate. And then people are not pissed off because the real estate prices are lower, and then they have more houses, especially also thinking that Germany got more than 1 million people. As I said, this is a wonderful paper, and my comments are on policy, and I only have one tiny comment on identification. Thanks a lot.
Tobias, if you want, you can take a couple of minutes to respond to the discussants' comments, and then we open to the floor.
Okay, thank you for that one. I'll try to keep it short in order to have time for the general discussion. So thanks a lot to both of you for these discussions. Sometimes you go into these conferences and think you have a very good paper, and after the discussions you go out and you think I have a paper. Yeah. Here I actually go out and think I have 5 more ideas for potentially great papers, which is fantastic. Yeah. So like all these ideas very much with ex-post polarization, the slide on value added kept me thinking all the time. So I think there's a lot of food for thought also for additional papers within our setting, or maybe also called to the audience. Just very quickly on 2 of the 3 of the things you mentioned. Identification, very well taken. We do something on QE. Refugees, we didn't really think about this so far. Our treated counties are more the slightly richer ones, where I think actually refugees were more placed in the slightly poorer counties in Germany, but we'll need to look into this. We'll just have to do this. Counter-cyclical capital buffers. I think that's a very interesting point, because I know there was a call for this. I also know that the German regulatory bodies, maybe Claudia Buch can even say more later on, tried to do that. It was also enacted slightly before COVID. So I think it's a typical situation where you get a lot of kind of lobbying against this. I was myself on a panel in these years where someone from the real estate industry said, we don't need this buffer. Germany is different. Yeah, and they didn't even know this book this time is different, so I couldn't even make that joke, so to say. Yeah? And so you get this political backlash, and the result is typically, as Raghu also yesterday said, that these things tend to be kind of too small relative to these other forces at play. Last short point, the relation to Große Rüschkamp, their paper. So these other papers are mostly in either other countries or in the European setting. And to be very clear, I didn't have enough time in the presentation because the clock was chasing me. There is some evidence which we're currently building that actually only in countries in Europe that were credit saturated did you see a significant increase in real estate lending, but in other countries it worked in a different way. So we're not saying it was bad for Europe, just if you zoom in on these credit saturated countries, this is what you get. And the other thing is, I think if you do regressions on the firm level, on profitability or employment, then real estate firms in the middle of a real estate boom are very peculiar types of firms. Yes, they are probably highly profitable. We should look into this. And if these real estate asset managers increase their staff from 2 to 3 people, that's a 50% increase if you do a regression in logs. Yeah? And I think there you have to be very careful when it comes to the real estate. Just looking at employment and profitability can be misleading, because employment is such a low base and profitability is highly itself dependent on kind of the real estate market situation. Thanks. I think I'll leave it for this for now and can take questions from the floor.
We have time for questions. I see already many hands up. Please stand up when you ask the question. State your name and affiliation. Thank you. You have microphones?
Thank you. My name is Leo van Taden from the ECB, from the Directorate Monetary Policy. I think this is a super interesting paper. I like it, but let me still reinforce one thing that was mentioned by the 2 discussants. I think there was something deeper going on in the background, monetary policy. I mean, the primary motivation of QE comes from the price stability objective of the ECB in a situation where many people felt that we were near to the effective lower bound. From this perspective, I think Germany was not a particular outlier. So if that is correct, I'm not sure, you can discuss it. I know that, I mean, you can think differently about QE. The true question you address in your great paper is how to structure flexibility across the available range of non-standard measures that you have in a multi-country monetary union with a lot of heterogeneity. You could argue from the perspective of your paper not to include Germany in this particular sub-program in terms of volume, very small to what we bought. The majority fell on sovereign paper, right? But if you do this, you have to do it program by program. And there needs also to be a certain balance. Assume in the sphere of sovereign papers we had to decide not to have something like the capital key. Then you would have to think about side effects of such decision. So I like your paper a lot, but the monetary policy main motivation would help to structure things.
Yeah, thanks a lot for the comment. So I don't envy central bankers who need to do monetary policy and these type of programs in highly heterogeneous currency unions. And to be very clear, we are not saying that this was welfare decreasing the program. We're just saying there are some effects in countries where these credit supply frictions existed, where they might have been alleviated. But there are also unintended consequences in those countries where these credit supply frictions didn't exist. So I looked at a lot of speeches, so credit supply frictions as a rationale for this program feature quite prominently. But to be very clear in that sense, I don't envy these policymakers who had to make these decisions, because in the end you're facing really a heterogeneous situations, and it's very hard in practice to implement a heterogeneous monetary policy across one monetary union. Yeah, it's just difficult for political reasons, but also practical reasons.
Raghu wanted to ask a question.
Yeah, Raghu Rajan, Chicago booth. Great paper. I think you can draw parallels to at least one big experiment in Japan in the late 1980s when they liberalized the bond markets. And a lot of the good companies went to the bond markets. The banks didn't know who to lend to. And that started the mother of all real estate bubbles in Japan. Seems very, very parallel to what you're showing here. But I think that raises two questions. One is the issue of financial development. You have a policy experiment. You could equally pose it as a financial development issue, right? That new sources of finance emerge, banks are then flailing around, and then they go into the stuff they know, real estate, as Amir puts it. That seems to be their go-to thing, and they just lend like crazy there. So that could have implications for what's happening in the US even today, right? With private credit expanding, all that we heard yesterday, that banks are now trying to look for new sources of lending, and what do they find? So that's one point. The second is it also raises this question, why don't banks sit on their cash? Why does the cash coming in have to be lent out? And it seems like first they draw it in, and then in a sense, they don't reduce their deposit rates and shrink their balance sheet. They want to continue lending. That to me is a huge agency problem, which we need to examine in greater detail. We call it sort of money burning a hole in your pocket, but I think it's possible in your data to look more closely at who's doing most of this and why. That would be interesting.
Thanks for this comment, and highly appreciate it. I think you highlight kind of 3 points or links to other areas. The one is the Japanese experience, and I just 100% agree. There's actually a really fascinating parallel paper that looks at this Japanese experience with exactly the message that you also have in your mind, and empirical identification and the like. So bond market liberalization might have a very similar effect to what we actually see here. The other point is, and I hope I could actually allude to what you were saying yesterday. You were saying yesterday that whenever banks see lots of deposit inflows, they want to do something with this. And what they do is probably not as good as that we were doing before, because they struggle to find equally profitable investment opportunities for the next project. And so I think this is a parallel. No matter whether you see a deposit inflow or a decrease in lending demand from some subpart of your portfolio, for some reason, I think that's not very well understood. Banks just don't shrink simply, maybe for operational reasons, maybe for other reasons, but they look for opportunities, investment opportunities, which are not necessarily good. And the last link I think that you highlight maybe indirectly is to the session yesterday on non-banks. Some people were quite skeptical about banks actually lending to business development companies that then go out somewhere else. But if you have the direct lenders like in Amir's slides, that are actually specialized maybe in lending to the service economy or the like, maybe this is an arrangement which is better from the welfare perspective. And then you can ask the question, why doesn't it happen in this context? And I'm beyond having an answer to this one at this stage.
There was a question on this side of the room, Oreste?
Oreste Tristani, ECB. Very, very interesting paper, and I was also struck by this high elasticity of the house prices to this increase in demand by a sector that, as you said, is very small. And I was wondering, so real estate prices have been soaring in Germany, especially in large cities, from ever since 2011-12. And I was wondering whether there is some correlation between these large cities and the richer counties that you mentioned, and whether this may also be affecting your high elasticity.
Yeah, so if you sort the counties, let's say, into those that you have in your mind, like city center of Munich, the big ones where real estate prices are very high, then the very urban areas, the very rural areas, and kind of then the middle urban areas, let's say, we find the biggest effects in these middle urban areas. So it's not in the city center of Munich or Frankfurt, but kind of in the outer areas there, for example. This is where we find the biggest effects. And so it doesn't seem to be just an effect of a larger development within these areas. If we, for example, sort counties by real estate prices prior to the CSPP into, I don't know, 5 quintiles or so, we see a differential effect in each of these quintiles depending on whether it's CSPP affected or not the counties. So what you're saying is absolutely true. There was a rise in certain cities, but it seems to be orthogonal to what we are measuring here. About the size of the elasticity, so whether it's small or large is sometimes a subjective feeling. I've also heard comments already, why is it so small? It's only 5 or 5 to 10% depending on when you look at. So keep in mind that the entire credit supply is going to the demand side, real estate asset managers, and not the supply side, construction or developers. And these real estate asset managers, they're only focused on these apartment buildings, but not single family houses or the like. And obviously, if a lot of lending only goes to the demand side and only in one segment, apartments, you probably get bigger effects than if it be more equally spread out across different sectors. Yeah, I think this is my best explanation. Otherwise, you can debate for a long time about is this too low or too high relative to the expectations you actually have.
Christian?
Thanks. Christian Kubica, ECB Research. A great paper, Tobias. I think it's very, very important for the design of monetary policy, and I think the key question for design of monetary policy is why does the money from banks go to real estate and not to the manufacturing sector? So where does this difference come from? Right? And I think there can be two explanations, and you and also Amir hinted at them. One is that banks simply prefer real estate. Could be because of the great collateralization of loans in the real estate sector. The other one, and you also hinted at that one a little bit, is the low elasticity in other sectors, right? So credit is very saturated already at this time in others. In manufacturing, it's easy to get credit. Credit conditions are great, and there's a very low elasticity compared to the real estate sector, right? And so I'm just wondering where are we closer to? Which extreme? Is it more that banks have a preference for real estate? Because if banks have a preference for real estate, then should we even have monetary policy directed at banks, or do we need much more directed monetary policy at small and medium enterprises if we want to affect small and medium enterprises? At the same time, and that's kind of a second question, is could there even be positive effects that are desired by monetary policy through higher real estate prices, boosting demand by private households because now their houses are worth more? Right? You talked about those spillover effects, and that might actually be good in boosting inflation.
Do you mind if I say something really quick?
Sure.
I just wanted to say that we've been trying to very carefully sort industries by the intangible capital to total capital ratio. And one of the things that jumps out at the data is high-tech manufacturing, medical equipment manufacturing, computer and peripheral equipment manufacturing is actually a very intangible capital industry. There's a lot of R&D, a lot of sales and marketing, a lot of working with customers, and so those are not natural places where bank credit usually goes. Those tend to be very VC finance, very private equity finance. So I just wanted to point that out, that even in manufacturing, especially in advanced economies, these are not usually industries that banks typically focus on a lot. Sorry, go ahead.
Yeah, just very quickly in the interest of time. So you're looking at this question, why? Why does it go there? And first of all, this is a big chunk of the pre-existing portfolio. So real estate asset managers make up 20% of this lending portfolio roughly. So as Amir already said, banks go where they already have expertise. You could ask, why don't they go into other 20% that they also already have? And our explanation is this combination. We cannot fully point it down to one of these, but the combination of it's in the interest of bank because of low risk weights and their expertise. But these are also the ones with the highest demand elasticity. So if you ease credit conditions, manufacturing firms will not double their loan demand, but if you slightly ease credit conditions, real estate asset managers are much more willing to take up more lending for the reasons I've explained, scalability, capital intensity, and the like. The second and last one, you said, is it maybe not unintended but intended, because an increase in real estate prices can have positive side effects. I'll leave it with a statement of policymakers at that time. Policymakers at that time were not cheering the real estate price increases in Germany, but if you look at publications by the ECB, by the European Systemic Risk Board, they're always very cautious in saying this is a warning, maybe countercyclical capital buffers should be enacted. So if we take these policymakers at face value that are specialists in analyzing whether this is more a threat or an opportunity, then it seems more an unintended than an intended consequence.
Let us thank the speakers for this fantastic first paper, and we will be back shortly with the second paper.